Tesla investors feel like they're on a roller coaster with rarely a dull day. The feud between Elon Musk and President Trump saw the stock fall 14%, the 10th worst trading day. Well, Cern Basher, a chartered financial analyst who's currently running his own investment advisory firm called BrilliantAdvice, is here to share some data and give insights on investing. In fact, studies show the average stock loses money. Out of 29,000 publicly listed US stocks, just a few lottery-like winners drove the stock market. 17 stocks delivered cumulative returns greater than 5 million percent. Like Warren Buffett said, the most important quality is temperament, not intellect. We've got Cern Basher here joining us, and he can explain how he thinks of Tesla stock, what's been happening, and some of his thoughts about investing. Thanks, Cern.
Hi, Herbert. It's good to be here. And just keep in mind, these are the good old days.
What do you mean?
These times, these crazy times that we're going through right now. We're going to look back on this and say, those were the good old days.
Yeah, I get you where you're going here. Well, this was pretty traumatic for quite a number of Tesla shareholders. They saw yesterday, June 6th, the fight between Musk and Trump saw the stock fall 14%. Of course, it's rebounded again, but when they see something like this, people freak out. The worst day was 21% down. I think you said this is the 10th worst day. Yeah,
that's right. The 10th worst day in percentage terms is actually the worst day in terms of dollar amount lost in the stock, because the company is now bigger pretty much than it ever was, or close to. So 14% drop on a $2 trillion company is a lot of money.
Okay, yeah, tell us more.
Yeah, so I mean, it's anybody that's invested in Tesla for any period of time has seen significant volatility. With this chart, I was just trying to put it in context, is that this is nothing particularly unique for Tesla investors. 14% drop is quite significant. It's not to be completely dismissed, but it is par for the course for Tesla investors, par for the course for NVIDIA investors, it's par for the course for stock market investors. You see these kinds of drawdowns from time to time. While they come out of the blue, they should not be unexpected. And so the question is, going forward, what should we expect? And of course, the important thing to keep in mind is that stock prices are driven by two things: sentiment and actual fundamental results. The fundamental results come at us essentially once a quarter. And then you have the rest of the quarter, the other 89 days of sentiment-driven stock market action, right? Based on things that may drive fundamentals or may not. But often it's sort of just fear and emotion that's in the market, right? And we've seen that time and time again. Even in this year, in 2025, we've seen sentiment-driven downdrafts in the stock based on all kinds of different factors, particularly around the tariffs that Trump has put on. And so, I sort of shrugged this off in the sense of saying, well, this is to be expected. This is normal for investors. If you're going to invest in Tesla or any stock for that matter, this is the kind of ride that you should get used to.
Yeah. I like that you came with research and data and what's happened historically and just putting everything in perspective. That's really cool. You also had a post that I really liked that you dropped, which is, quotation mark, investment advice. Investing is as much a psychological endeavor as a financial one. Success hinges on embracing uncertainty, managing emotions, and acting deliberately. And you got this AI version of an investor who's like so worried about the stock going up. What's your way of thinking about things?
Yeah, I'll take you through the details of this post in a minute, but just the image itself, the idea I wanted to get across here is that we're all learning at this. Even, as in my case, I've been at this 30 years. I still feel like I'm learning markets and how markets work and so on. But I do think that 30 years of experience gives me some insight that perhaps a lot of investors today don't have. And in this show, we're also going to draw on the historical wisdom of Warren Buffett and Peter Lynch. We'll show some of their quotes. But before we get into the topic of this particular post, let's set the stage a little bit if we can. So there was a study put out by Research Affiliates, and they're highlighting the fact that passive investing now has more than eclipsed the amount of active investing. So let's define that. When you invest in a passive way, you're just tracking an index, typically a market cap index like the S&P 500. And active investing would be you're actively selecting stocks.
Hmm.
And so in the professional investment marketplace, or just in general now, that there's more dollars in passively managed index funds than there is dollars actually actively managed by somebody. Now, there's good reason for that. If you just flip to the next page, you'll see how this trend has transpired. So there we have now 53% of assets managed in a passive way, and 47% managed in an active way. So just think for a second then how companies' prices are set in the marketplace. If the entire market is actively managed, then basically every single trading activity by the participants in the market is sort of helping with what you would call price discovery, figuring out what the right price of a company is. Okay. If we go to the other extreme and we have 100% of the stocks in the market passively managed or in an index, then there is no price discovery. It's just whatever the weights of that index is. Every dollar that flows in, it gets parsed out into the different components, and each company gets a slice of that investment. So right now we have about 50-50.
Hmm.
And the question is, at what point do we get into trouble with this, where so much money is indexed and we start to lose that sort of price discovery component? Or it might be the case, let's say we get to the point one day where it's 90% indexed and only 10% active, then you could argue that 10% of the investment dollars is setting the prices for the entire market. And that feels a little scary. So right now, 50-50 maybe doesn't seem so crazy, but this is something worth looking at. On the next chart, you'll see that for years now, and of course the previous chart belies this, that the flows into passive funds have been positive, and the flows into active funds pretty much have been negative, except for a couple of years. So again, that previous chart showed this trend. So this is a very consistent trend over a long period of time. And there's a really good reason for this. If you just go to the next part, this image basically shows it, that the average mutual fund or the average active investor has underperformed index funds by an amount at least equal to their fees,
Really?
in some cases more. Right. And it kind of makes sense because
Wait,
if
this
the
is
average
average
investor,
mutual fund. This is average mutual fund, not necessarily a retail investor picking, their own
well,
stock.
I think you could broaden this out and say the average market participant would underperform an index by whatever their costs are. So in the case of mutual funds, it's their fees. In the case of retail investors, it might be their trading behavior, right?
Is it fair to say that the reason why this is that analysts who run mutual funds, they claim that they're smarter than the market, but they really aren't. They're really performing just like index funds are. You have a basket of funds and it goes up along with it or down along with it, but you have an extra fee, and so you actually lose at the end of the day. It's like a casino. Over time, you lose. Is that the way to
Yeah,
think of it?
I think so. I mean, it's really quite simple in the sense that every single market participant collectively is the market. So if you take out the portion now, let's say 50%, that's indexed, that leaves 50% remaining, and those people still collectively represent the entire stock market. So those people, those funds that are actively managed, they represent the entire stock market. They're going to underperform the market by their costs. It's just a mathematical proof. It's obvious in that sense, right? Whatever costs they have, expenses and fees and so on that they're charging, because collectively they still represent the entire stock market, they're going to underperform. So the rise of the index funds is no great surprise. It's actually been a really incredible invention. Jack Bogle at Vanguard was one of the pioneers of this. And so index funds now kind of rule the roost, right? And again, for good reason, because they outperform the average active investor. But here's the problem, Herbert. Yeah, on this page. The problem is if you think about market cap indexing, how do you set the weights of a company in a market cap index? The weight is simply the market capitalization of the company. Whatever the market cap is relative to the total market value, that sets the weight. Okay. How is the market cap set? Well, it's set by investors who pay whatever price they want for the stock. So you have this situation where any company that becomes popular or potentially overpriced, therefore has an overweight position in the index, right? If you use some other method to set the weight of each company in the index, besides market cap, you wouldn't have this issue of worrying about whether companies were overpriced or not. Let's say you used something like revenues, cash flow, earnings, even dividends, things that are not tied to the market cap of the company. They're more fundamental in nature. Then you would solve for this issue of an index fund, the S&P 500, for example, having too much in popular and overpriced names. Okay, so this is also a fundamental flaw of index investing, market cap index investing, is they're overweight all the overpriced names. Now the question is, which ones are those? It's not so easy just to look at the index and say, oh, that company's overpriced, that company's overpriced, these are underpriced. Now we're getting back into the active management realm again. And we've just shown a second ago that that hasn't worked. So we have this interesting problem of the market cap index is superior to active management, but yet the market cap index has some terrible flaws, right? So it's one of those things where what was invented as a market cap index is great, but it also isn't perfect, like a lot of things in life. Let's shift gears. So there's a famous Peter Lynch quote. He says, owning stocks is like having children. Don't get involved with more than you can handle. And so what's he getting at here? Well, I think Peter Lynch intuitively knew the results of the next couple of studies. And this, I think, will blow people's minds. There's a professor at Arizona State University, if you go to the next page. He's done a few studies now over a period of time that has looked at the lifetime returns of every single company in the United States since 1926. Right? Massive database of stocks and annual returns that's been put together over many, many years. And some of the findings of his studies are absolutely astounding. This is a study he did from 1925, December 1925 through December of 2023. There were 29,078 publicly listed US stocks. And as you mentioned in your intro, that there were a few lottery-like winners that drove the stock market, okay? For example, 17 companies delivered returns over their lifetime in this period that were more than 5 million%. Phenomenal, right? And I'll show you the list here in a second. But just 86 stocks accounted for half of the 16 trillion in wealth creation during the last 90 years.
Mm-hmm.
Keep in mind, we're looking at over 29,000 companies. Yeah. And only 86 of them accounted for half of the market's gain. Yep. So again, go back to this discussion we just had previously about indexing the market. Most of what you own in a market cap index is useless. In fact, it's a drag on your results. So again, the question is, does indexing make sense, or is it better to try to be active? Yeah. If you knew in advance what the 86 stocks were, great. Obviously, that would be the way to go.
Yeah. I always found it funny with index. I mean, at the end of the day, you're just, 30 stocks, 50 stocks, 500 stocks. Like, yeah, you're in the market. You're just going wherever the market goes. It's safe because we know the market always, over time keeps going up with dips on recessions and so forth. But that's because technology and progress keeps making companies improve. So generally, most companies improve. But you're not really, you're just going along with, you're just putting money, which is fine. But if you really wanted to pick, that's where you don't know. How do you know which ones are going to be the 86?
The challenge too to keep in mind, well, the first thing to say is that index investing doesn't require you to have any foresight. You just own the entire market and you get all the winners. Hopefully all these 86 companies are in the index, but you also get all the losers. And because the winners are producing so much value, even though the losers are losing money, net, you're making money over time. And that's been true, and that's been great. And then index investing, again, has been a fantastic invention. The problem is, even indexes themselves have an active component. Think about Tesla's inclusion into the S&P 500. On the first chart you showed, the worst day Tesla had was down 21% when the S&P did not include them in the index when people thought they would. Mm-hmm. Right? So the S&P 500, there's a committee that chooses those 500 names. Right. And there are other companies now waiting for their inclusion into the S&P, and people are excited about the prospect of that. So that's also an issue too. It's not like, every company gets put in the index the moment that they qualify. There's a period of time that goes by. Now, it turns out that Tesla's best day was when they were put in the index. So the worst day was when they weren't. And then 3 months later, the S&P committee announced that they would go in. So it's not like index investing is not without its flaws. I've mentioned two of them. Again, there's a committee that picks the names, and then the way that the index is constructed also has its flaws. The worst example of an index is the Dow Jones Industrial Index that everybody used to talk about, and now no one does. That committee has had a horrendous track record of taking companies out of the Dow and putting companies in at precisely the wrong time. There's so many examples of when they did that at the wrong time. They essentially bought high and sold low many, many times. Okay, on the next page, Herbert, is the list of the stocks with the highest lifetime returns. Like it or not, Altria, formerly Philip Morris, has the highest lifetime return because it's got data going back to December 1925 through the end of the study, December 2023. So it's a company that's been around 98 years. And it's up, an average of 16% per year for 98 years.
And this is 1925. This is 2023. Yeah, 98 years.
Yeah.
Okay.
Yeah, sorry, it's a little confusing there, isn't it? They should have put the 19 and the 20 in front of the year numbers, but yeah. I guess if you focus on the years column, you can see the length of time. Vulcan Materials, Kansas City Southern Railroad, some of these companies that have been around a long time actually have done very, very well. The company on there with the shortest, I'm just scanning the list, with the shortest time span, we've got Northrop Grumman, 72 years. It's been around a long time. There's nothing on that list that's particularly new.
Yeah.
Right. So staying power certainly is a big part of this, and certainly being able to, compound earnings over a long period of time is important. And then the next page is a bit more of a recent look. This is the highest annualized compound return for any stock with at least 20 years of results. So NVIDIA is at the top of this list, right? So NVIDIA has compounded at 33.38% per year for 20 years. Netflix is high up. Amazon is high up on this list, compounding results over the last 20 years, over 30%. And there are some other companies on that list that you can see that the last return date was some time ago. Sperry Corp, for example, in June of 1955. That's been a while since that company's been around. So there's Microsoft on the list there, compounding 26% per year. Home Depot has been pretty incredible, and so on. So the nature of the companies that are on these lists do change over time. And that's also another challenge, is that NVIDIA, again, has performed really well over the last 20 years. Will it produce really well over the next 20 years? That's an open question. There's always a backward-looking nature to this, and it's obvious now as we sit here today to look at this list and say, oh, yeah, this makes sense. This company did well. Of course it did. Of course its stock went up this much. The challenge with investing is to look forward and figure out, what will this list look like 20 years from now? So just some other conclusions from this studies on the next page. All of the wealth creation over the last 98 years, it can be attributed to about 1,000 stocks out of the 29,000. And the remaining 96% of the stocks collectively match the return on cash. But even more astounding than that, half of the stocks had negative returns. They lost 7.4% per year. So most of what you own in an index fund is a drag, a major drag on the results. The reason that you invest in an index fund is to say, I don't have the confidence in picking the winners. I know there's going to be a ton of losers, but you know what? The winners will make up for it, and I'll be fine. Nothing wrong with that approach. Absolutely nothing wrong with that. Right. And basically, you're investing your money on the backs of everybody else that's doing the work to figure out which stocks are worthy of going up. And again, nothing wrong with that. You can save yourself a lot of money, a lot of fees if you just own an index fund that costs, 3 basis points, 0.03% per year. On the next page, again, I wanted to highlight from an earlier study that Henrik Bessenbinder did. And again, this is from essentially, I think, December 1925, call it January 26th, through this time, 2019. The previous numbers were from 2023. So this is 4 years earlier. Right. And at this point, they had 26,000 firms. As of this date, 57, almost 58% of the firms had stocks that reduced shareholder wealth, right? So the stocks had negative returns. And the total net shareholder wealth increase through this time period was $47 trillion. And tech firms accounted for $9 trillion of that. Okay, but of course, this is a long period of time. So telecommunications, energy, healthcare, and so on also contributed a lot of that growth. Okay, and again, the same results, that there was a concentration in the few top performing firms. And at this time, 5 firms accounted for 22% of the net wealth creation. Again, just driving this point home that there's very, very few companies that contribute to the net wealth creation. And so in this quote, and I pull it out again at the bottom, these results should be of interest to any long-term investor assessing the relative merits of broad diversification versus narrow portfolio selection. Very few companies are creating all the wealth. And as an investor, you need to decide how you want to tackle this. Do you want to just be an index investor and just own everything and let the cream rise to the top? Or do you want to try to be a stock picker and try to pick the winners? And if you're not indexing, then you're engaged in active management. And right now the marketplace is, roughly 50-50 on that in terms of how, where investors are. Here is on this page, the top 50 firms in terms of wealth creation as of December 2019. So it's a little bit dated now, but I think still pretty instructive. So Apple is at the top of the list. Total wealth creation of 1.6 trillion. It accounts for 3.5% of the total wealth creation. Microsoft is second, and then we've got Exxon, Amazon, Alphabet. So the Mag 7 has a pretty good representation on that list. As of this time, Tesla had not made this list. Again, this is December of 2019. This is before Tesla's big run up. But you can see there, this top 50 list accounted for about 41% of the total wealth creation. Do you think you can pick these stocks? If you can get outstanding returns.
I did.
Yeah.
I picked Apple.
Yeah.
But so the other thing that Peter Lynch said was that if you decide to be an active investor, you need to be active, you need to be following, you need to be researching. You should only handle, just like kids, how many you can handle. So you really shouldn't do 20 when you can't spend that much time following everything. Otherwise, just go ahead and do the index. But that's what he's saying. It's like, if you're going to do it, do a handful, but really research it.
Yeah, one single person can only really truly understand deeply only a handful of companies.
Yeah.
There's just too much work involved to understand, 50 or 100 of them, right? It's really difficult. People that do often get sort of bandied about by the market because they don't truly understand the company, and they often get scared out of their positions when there's one bad quarter, right? On the next page, Herbert, this is an interesting table as well. This is shareholder wealth creation, again, as of December 2019 for 3-year periods, right? So from the top there, 1929 through 1932, et cetera, just 3-year periods. The thing that I want to draw your attention to is that last column actually is a good one to look at, where you've got your cursor. So the number of firms that accounted for half of the wealth creation over that 3-year period was 2.63%. Okay, and if you go down that column, you can see it's remained very, very low. And the average of that column is 2%. 2% of the firms over any given 3-year period account for half of the wealth creation.
Yeah.
Right. So again, every 3-year period, you've got to make sure that you're, picking the right companies, because they, again, if 3 years is your time frame, which is very short, but it's just instructive to show that there's always very few companies, no matter what period you look at throughout history, that are driving the returns in the market. And then finally, from Peter, when you sell in desperation, you always sell cheap. I think those are words of wisdom. And of course, with what happened yesterday between Elon and Trump, or what may have happened yesterday between Elon and Trump, I heard a lot of desperation in a lot of people's voices, a lot of comments that I saw, a lot of frustration. And that's often a very dangerous time to sell. So let's get back to my post that I labeled investment advice in quotes. So one of the points I want to make is that investing in stocks is not an exercise in comfort.
Yeah.
It really isn't.
No.
You might feel good about stocks when they go up, but you know what? They're also going to go down. Volatility is just part of this game. Stock prices are more volatile than the underlying businesses, right? You have to accept that. Sometimes there are things that corporate CEOs do to make their stocks volatile. Again, Elon Musk is an example of that, right? So if you're looking for comfort, picking individual stocks probably isn't the place to be. Okay, so part of this is knowing who you are and whether or not you can handle this game. The other statement here, and this is, you can put it in this is obvious camp. There are always more unknowns about the future than knowns. We actually know very, very little about the future. You could argue, actually, we know nothing about the future, right? So we're operating in a fog of unknowns. How comfortable are you operating in a fog of unknowns? Like, really ask yourself that question if you're investing in individual companies. Are you comfortable with that? If you're not, this is going to be a tough ride for you.
And there is a kind of a range, a scale of how comfortable you are.
Yeah.
And you know that it's a bet. But then there's some, it's not just a bet if you study it, there's a bit more investing in it. And you kind of move the scale a little bit more to your, not the scale, but the probabilities to your side. But at the end of the day, some people are like very willing to invest and just make it a bet. They go, this is just a bet. I have no idea what's going to happen. I'm okay. Others are so conservative. They go, I don't want to lose my money. I cannot lose my money. So in that case, you really should not be betting in things that are very, very, everything is unknown. You don't know, but you have to like be much more careful.
At one point early on in its life, Amazon stock went down 97%.
Wow.
Mm-hmm. Right. And look where it is today. It's on one of the, the lifetime value creation list near the top over the last 20 years. Again, these things happen. The other point about this, the bottom part of this page here, is there are also many unknowns about the present as well.
Mm-hmm.
An example of that, I think, is yesterday again. Very instructive. We all saw the same facts. We all saw the tweets going back and forth between Elon and Trump. We can all look at the same earnings report. We can all see the same thing playing in front of our eyes, but we can all draw very different conclusions about what we're seeing, even though we're watching the same thing. Who's right? Who's wrong? I don't know, right? Everybody draws different conclusions about the same set of facts and data. Again, recognize that and recognize that that creates opportunities, but also recognize that you could be wrong about how you're thinking about things. And there's probably a good chance that you are. There's a good chance that we all are wrong about how we're seeing this particular spat between Elon and Trump. So that's important. And that matters in terms of how you approach investing. On the next page, not every action in the stock market requires a reaction from you. The market is this constant stream of information and price movements and headlines, and some people are motivated to try to part you from your stock. Other people are just putting stuff out there. They may not have any ill will. They're not trying to do anything. They're just putting information out there that's scaring people. And of course, in this attention-oriented world where, getting eyeballs makes money for people, there's that aspect as well. So just recognize that. And to have the discipline to know when to act and when to do nothing is critical. And for an individual investor, you have the ability to be extremely patient if you want to be. You don't have anybody asking you, what's your quarterly return versus a benchmark? You don't have anybody saying, if you don't deliver this kind of return, I'm going to fire you. You don't have those pressures, right? We're not individual investors are not professional investors. They have those kinds of pressures. You can filter out the noise if you really want to. So I'm just suggesting that, when you feel that way, let the dust settle if things don't make sense. You don't have to act. Presumably you did your homework and invested in a company and a stock when things weren't so crazy. Presumably you thought about this. If you didn't, then I would understand why you might be uncomfortable, right, when some of these things happen that causes volatility in a stock. But if you did the homework, if you did your own research and you have the courage of your conviction, just let the dust settle. You don't have to make up your mind today, right? And that's very difficult for a lot of people. Anyway, I don't know if any of that's helpful, but that's sort of the way that I approach it. As I mentioned in a follow-up post, I said, don't take my advice. Listen to the Oracle of Omaha, Warren Buffett.
Yeah.
And he, of course, has so many great quotes. This is just a few of them. He says, I never attempt to make money on the stock market. I buy on the assumption that they could close the market for the next day and not reopen it for 5 years. Yeah, how many people would be happy with that?
He'll only buy a company, a stock. He doesn't think of it as a stock. He's not trying to buy and sell the stock. He's thinking, okay, I'm going to buy the stock and I'm going to look at it again in 5 years.
He's going to buy this business is how he's thinking, not the stock. Yeah. And then the most important quality for an investor is temperament, not intellect. He has a quote that he says, if you look at librarians who are the most well-read, maybe the most well-read people, why aren't they the richest people in the world? Well, it's not just about knowledge and being well-read. It's about emotions, temperament. Yeah. And then the next two quotes, if you aren't willing to own a stock for 10 years, Don't even think about owning it for 10 minutes. Those are great words of wisdom, in my opinion. Now, there's a lot of people in the stock market that are trading it every day or every week. Don't confuse them necessarily with investing. That's different. That is speculation. There's nothing wrong with speculating on stocks, but don't call it investing if you're not owning a stock for 5 or 10 years,
Yeah.
or hoping to at least. And then, as he points out, remember that the stock market is a manic depressive. It just is.
Yep, it just is. Yeah, people get excited and then they overexcited and it's a boom. Then they get really sad, but then they're over sad and it's depressed. Yeah.
And then the last quote, I'll let Peter Lynch have the last word. The key to making money in stocks is not to get scared out of them.
Hang on.
Inevitably, there's something that's going to happen with every single company that is scary, and it creates uncertainty, and and again, this guy had a lot of experience and was very successful, and this is even back in his time.
Yeah.
And
it's only gotten out of control now with social media and how everything's exaggerated, worse now than it ever has been. Don't get scared out of them. How do you Cern, distinguish between discern? How do you discern between signal versus noise? So noise is just lots of things happen, but really doesn't affect fundamentals, doesn't affect really the business itself. Then some things, okay, that is serious. That could change the fundamentals of this business.
Yeah, and there's a lot of noise that could become signal. It's not easy, but I think it comes down to what's your thesis on a company? Why are you invested in a company? And again, if you're looking out for at least 5 or 10 years, you're not really worried about one quarter to the next. So for example, let's talk about Tesla just specifically. It makes it easier if we have a specific example to talk about. Elon gets involved with Doge. There's some political backlash. There's concern that people aren't buying Tesla vehicles. Okay. I'm sure that's affected sales. It's also attracted some other people to the company, but let's just assume, for example, that it is net negative. There's been demand destruction. Let's just agree that that's the case. Whatever the number is, who knows? Well, then that means that for the next quarter or two, or a few quarters, or even a couple of years, Tesla may sell fewer vehicles. Okay, that's absolutely negative. But my thesis for the company is not centered around how many vehicles they sell. My thesis is centered around this transition to autonomy and robotaxi, and then ultimately humanoid bots. So as long as I see them making progress on that, then I'm willing to suffer the slings and arrows of the short-term issues, because I'm investing in something different than what the company is today.
Yeah. Your short term is 2 years. Yeah, your short term is 2 years. Others' short term is quarters or this year. Yeah. And they say, well, yes, that's all good. I'm a bull, Tesla bull. I see the future, but I will hold on to my money now, not invest in Tesla today, because it's going to go down in the next quarter, 2 quarters, year, and then I'll wait until these other things happen. I can invest my money in something else, right? What's your reaction to that?
Nothing wrong with that. Again, know who you are and what you're looking for, and the time frame, I guess, that you're looking for things to play out. Some people are just naturally much more short-term wired than others. I would submit that it's going to be very difficult to know when to get back in precisely, right? The big move that Tesla had last time, was that obvious to everybody? I don't think it was. Right. Some of the people that had owned the stock before that, they would tell you it was obvious to them. But then there were other people that were chasing that move up, right, and kept needing to chase it as the stock kept moving up. And so if the economics of autonomy are what we think they look like, and when I say we, people in the community like ARK Invest and other people that have done the modeling of robotaxi, myself, Joe, all kinds of people, AJ, if that business is anywhere near as attractive as we think it likely could be, as Tesla executes on that, the stock could have a phenomenal move. I would prefer not to have to worry about timing that move, right? And just position capital on the expectation that's going to come. Of course, I'm following that very closely. And it may make changes in terms of the position size around that. But I'm not looking to be in or out of the stock just based on, where the company is quarter to quarter. I personally think that's a very difficult thing to do. A lot of people resort to reading the tea leaves or reading the charts. That's not something that I really do.
Yeah.
Some people have some success with that. Some people have very mixed success with that, and some people have no success in doing that, because you're looking at the chart reflects kind of the market's real-time emotions. And so if the chart turns, positive, is that really a strong signal? Well, maybe in the short term it is, but that can change very quickly, as
Yeah.
again we saw yesterday.
So, it'd be good to get data, because you shared so much data, very valuable data but I'd like to see more data on momentum investing. And I don't know what the definition is, but I would assume that it's, momentum investing would be a year, like, within a year. You decide to buy a stock, sell it, buy another stock, sell that, and you're trying to move your money into which ones you think is going to be the next up. Of course, most people are very aware that I think they're aware that no one's figured that out. If you can time the market, you'd be a billionaire, trillionaire, whatever it is. Few people is able to do this. In fact, most people cannot, because you cannot predict the future. However, because we can
the comment with that, Herbert, is show me all the billionaire traders.
Right. I mean, even Warren Buffett, what does he do? He holds on for decades. That's what his goal is, right? Decades. And so then the data you shared here today showed that, that you can get these returns, outsized returns over years, and it is a select group of stocks. So I think for the majority of investors, and that's the challenge, isn't it? That there's so many definitions of categories of investors. Just, you probably know how many there are. There's probably 100 different kinds of investors. There's the senior citizen who needs the cash in the next year because they're retiring. There's the, teenager. There's, what I'm saying? There's like all these different needs, different scenarios. But so if you just invest in, maybe index is great for you because you leave it alone. Stock market, years, you'll do okay. But if you're in a growth stage and you're not worried about the fluctuations, and you're not worried you're willing to take a risk, but you really want outsized growth, you should try to pick your stocks, and you should pick 5 of them or something like that, whatever number you feel comfortable with. And then you're trying to find the ones that are real businesses that are about to disrupt industries. That's my strategy. Of course, have different strategies. And then if they do disrupt that industry, the returns are outsized versus any of these. And what the data you showed is proof that the vast majority of companies don't. It's like flat. It's only a few that really make the returns. So you should try to find out which ones are your thesis.
Here's another way to think about it is, if you have a very long-term investment horizon, let's say 20 or 30 years or even 10 years, you can get away with making very few decisions and say, like Warren Buffett says, don't own the stock for 5 minutes if you're not willing to own it for 10 years. You don't have to make many decisions. You need to do your homework, figure out what companies you want to invest in for a 10-year period, buy them, and basically, you can forget about it essentially, but you want to monitor them. You want to make sure they're on track. The shorter your time horizon, the more that others' actions matter. If you own a stock for a 10-year time horizon, I don't care whether it goes down 50% tomorrow. I mean, bad timing, that would suck, but your time horizon is 10 years. But if you're owning the stock for a day, then what happens makes a huge difference. And at that point, the decisions of other people factor into your decision-making process.
Yeah.
Right? So it's a combination of those two things. If the shorter term you are, the more the decisions of others are going to impact your investment. The longer term you are, the less the decisions of others, the emotions of others, the manic depressive nature of others will impact your decision-making process. That's another way to sort of segment the two. And I think as an investor, I think you need to decide, how much do I want the decisions of others to impact my thought process?
Well, the challenge, Cern, is that the world has changed where it's moving so fast. No one can predict what's going to happen in 3 years. Like in 3 years, we might have AGI. We might have no need for cars anymore.
Yep.
Anything like these big things a new invention could come and totally eliminate the pharmaceutical industry. I mean, literally, we're there. We're there where within a year, 2 years, all of a sudden, things have changed. So yes, you should have a long-term view, but it's like it seems to be that you've got to be really focused on things could change very quickly.
Yeah, no, I would agree with that. Again, I think this idea of buying a stock, making one decision, and then putting it away and forgetting about it for 10 years is probably a dream. It's probably a quaint idea at this point. You have to monitor things. Things are changing very quickly. I was just trying to get across that the shorter the time frame you have, the actions of others are going to matter. If you have a longer time frame, the actions of others in the short term don't matter at all.
It's the business. What matters more is just the business. Is the company going to survive? Are they going to? What's happening in the environment, technology, and
And of course, the progress of a business is also open to interpretation. Again, as I mentioned, you and I can be looking at the same earnings report and come to different conclusions. So that's hard enough, let alone adding on how are others going to react about this. If I have to worry about your reaction to the earnings report, that's another layer of thought process on top of my analysis, right? So again, as an investor, you just need to think about to what degree you worry about the thoughts of other investors. It's an interesting, complex game for sure.
Mm-hmm.
Yeah.
Good data, Cern. I appreciate that you came back with that. So we learned a few things here today. I didn't know that 50-50, pretty well, 53-47%, passive versus active investments. That, it's just a small handful of stocks make up the vast majority of gains. I think you've already shared that also. It also works, right? You shared this in a previous show that even in Tesla itself, just a small handful of days, Tesla stock is what made most of the gains. I think you call it 41 days in all of Tesla's history of trading history since IPO, made up for all of its gains. And so because of that, the insights out of that is that you cannot predict which day that those 41 days are going to happen over this long period of time. No one can, honestly. So you better just pick the company, know that it's growing, know that it's winning, know that it's innovating, know that it's well run. Case cash is growing, everything's happening well. The things we're betting on, it seems to keep improving. We're heading in that direction, and so then you'll just hold on to it. For this specific scenario right now, right?
Well, the other thing too that we identified was that all of the returns in Tesla and frankly stocks like Nvidia have come when the stock market was closed. Overnight,
nighttime.
Over the weekend.
Yeah.
Right. And during the day, the trading activity in the stock from open to close was a net negative on the stock.
So you really shouldn't even do anything during the daytime. Just hold on to it because you don't. It's very interesting. Yeah.
Right.
And you also said that, by the way, Tesla's not the only volatile stock. Every company you showed, right? Microsoft, Nvidia, they have all gotten them huge drawdowns. So some reason people think Tesla's, that's a terrible company because people just dump at the stock. Well, it's not the only one.
Yeah. And I would also challenge the thought process out there that sort of says volatility is bad. I would say that business schools have generally taught that. And we have, tons and tons of people out there trying to do things to minimize volatility in companies' earnings and that kind of thing. But an alternative way of thinking about it actually is volatility actually can allow you to create a lot of income if you so desire. So for example, think about options. What makes one call option more valuable than another? Well, if they're the same in every other way except volatility, then the one call option will be worth more than the other. The call option with the higher volatility assumption is worth more than a call option with lower volatility assumption. If you sell that call, you can generate a premium. You can generate income. So the higher the volatility, the more income you can generate. Again, we're starting to see some people use that to their advantage and create sources of income. There's ETFs, there's ways to do it with individual stocks. It's become really interesting. And I would just mention here, this is not about this company, but a company that's really doing that right now in the marketplace, showing how this can be done, is a company called Strategy, formerly MicroStrategy. They've engineered their stock to be one of the more volatile stocks in the marketplace. And so we're starting to see this notion of volatility equals bad be challenged, and very effectively so by them. And also it works favorably too for investors in NVIDIA and Tesla and other volatile stocks. You can actually turn that volatility, if you so desire, into an income stream. And so that's also a change that we're seeing. And it certainly impacts Tesla investors. So if you're looking for income, highly volatile stocks actually can be very useful to you.
That's second level info there. Appreciate it, Cern. Thank you very much. You always come with good data, and always learn something from you. Follow Cern. He's got his own financial advice company called BrilliantAdvice. And then check him out on his X account. That's Cern Basher. Thanks, everybody.
Bye. Thanks, Herbert.
I've created a website that is the most comprehensive resource for the Tesla investor. Please check it out. Simply go to my website at herbertong.com.